Hello, everyone. Thank you for joining us for today's event featuring Catherine Weiner, Global Head of Stewardship at Goldman Sachs Asset Management, in conversation with Diane McKeever, co founder of IDES Capital Management. My name is Sri Chatterjee, Professor of Finance and Business Economics at the Gabelli School and Gabelli Chair in Global Security Analysis. And it's my pleasure to be here on behalf of the Gabelli School. The Gabelli School Centennial Virtual Speaker Series began in 2020, marking 100 years of purpose driven business education at Fordham. In the last year, the Gabelli Center for Global Security Analysis and our wonderful partners, the Museum of American Finance and the CFA Society New York, have sponsored more than 50 events that have drawn 10,000 plus attendees. We are tremendously proud of this dynamic partnership, and a full archive of our video content will be shared in the thank you email you will receive. In just a moment, I'll hand over to Diane McKeever, who will give a full introduction to Catherine. Diane and Catherine will speak for about 40 minutes, at which point they will address questions submitted through the question field that is located below the video player. Please feel free to submit questions at any point during our event. Before I turn it over to Diane, I want to warmly ask you that you consider making a donation to the Gabelli School Centennial Fund. You can make a tax exempt gift quickly and securely online at the links provided in the chat. And now, without further ado, I'm happy to welcome Diane McKeever.
Thank you for that warm introduction, and good evening, everyone. I am absolutely thrilled to be here tonight with all of you, and most especially to speak with our very esteemed guest, Catherine Winter. I've had the real pleasure to get to know Catherine over the course of our joint tenures on the Council of Institutional Investors Corporate Governance Advisory Council, which Catherine chaired this past year, a role in which she truly excelled, leading the council during what was certainly a sea change year for corporate governance, ESG, and investment stewardship. And this evening, we are going to be diving into those themes. But first, I'd like to take a moment to share more about Catherine's role and her career. Catherine Winter leads the global stewardship team for Goldman Sachs Asset Management. In this role, she manages the firm's global proxy voting policy, which informs nearly 10,000 annual votes across 71 different markets. She also oversees approximately 400 annual company engagement meetings covering such key topics as diversity and inclusion and disclosure of material ESG data. Through these programs, Catherine promotes the adoption of best practices in corporate governance and amplifies Goldman Sachs' commitment to accelerating the climate transition and driving inclusive growth. Catherine is a 1 million Black women ambassador, helping to drive the strategic direction of the initiative. She further contributes to industry stewardship by serving on the Investor Advisory Group for the Sustainability Accounting Standards Board, as well as chairing the Corporate Governance Advisory Council within the Council of Institutional Investors. Prior to joining Goldman Sachs Asset Management, Catherine was a vice president in corporate governance at Morgan Stanley Investment Management, where she was a member of its Proxy Review Committee, ESG Working Group, and Morgan Stanley's Women in Business Alliance. She started her career at Lord Abbett, where she built and grew the corporate governance team. Catherine earned an MBA from Fordham University Gabelli School of Business in 2009 and a BA from Colgate University in 2002. And it's my true pleasure to welcome Catherine Winter. Hi, Catherine.
Hi, so delighted to be here. It's quite an honor. Thank you so much.
I'm so thrilled to get to talk to you today. Our audience is in for, a lot of learning and a real treat in hearing from, you, a true expert. So Catherine, I read everything you've done. And first I say you've been busy and you really are a thought leader and an expert in what has certainly become a front page. And I would even argue the front page topic in business and in investing today, investment stewardship. And, since that topic is really the central theme in tonight's conversation, I am going to take you up on your excellent suggestion to kick off our conversation with some definitions and level setting and ask you to explain to our audience what is investment stewardship.
Sure. Well, again, thank you so much for being here. It's an honor, and I love being back at my alma mater. So thank you so much for having me. So we define stewardship at Goldman Sachs Asset Management as the responsible allocation, the management and oversight of capital that creates long-term value for clients and beneficiaries. And we think about it in terms of long-term shareholder value creation, but it's much more broader. And we'll talk a little bit about how this space has evolved, but it's gone from shareholders now to broader stakeholders as well. So that includes employees, communities, and the environment. And we'll talk a lot about that. So our goal in the stewardship team is to unlock value at our portfolio companies by promoting best practices in ESG, which is environmental, social, and governance, and broader corporate governance practices. At GSAM, we're a diversified asset manager with over $2 trillion in assets under supervision. So we want to protect our clients' capital and put that to work and try to unlock value through two main tools that my team oversees. So the first one is around proxy voting, and we'll get into a lot more specifics around the activities that we conduct. But as you mentioned on the onset, my team votes at approximately 10,000 company annual meetings every year. So what does that really mean? And to define that, as shareholders of publicly traded companies, we have the right to vote at company meetings on matters such as the election of the board of directors, compensation of top executives, and company-specific matters that might be proposed by management and also may be proposed by shareholders, because as a shareholder, you have a right to bring forth proposals to be voted on by other shareholders. So our proxy voting policies, and we'll talk a little bit about that, allows us really as long-term investors with an opportunity to express our views directly to management through our voting activities. So we vote, both through our public voting records, which are available on our website and disclosed through our mutual fund filings each year. And then also we engage directly with company management as well, which leads me into my second pillar and focus of my team is really around a company engagement. So my team helps guide conversations with our actively managed investment teams, as well as a standalone from my team's perspective as well. We meet directly with management teams of our publicly traded companies and provide feedback directly to them on material ESG issues or on items that we might be voting on the proxy as well. My team conducts over, like you mentioned, 400 to 500 meetings a year, and we are based across 3 regions. So I have team members in Tokyo, London, and in New York.
It is an impressive phenomenon, like what you do. I mean, I have to say, as someone who invests and has a concentrated portfolio, and I know kind of what engagement looks like, the scale and the breadth of engagement and the number of issues you're engaging on with the number of companies, it's unbelievable to me. And when I read those numbers, I really could appreciate that, and I think a very special way. I think that is such a great. Yes. And it's such a perfect kickoff. It really highlights, I think, so many of the themes we're going to touch on. I always like to start conversations, I think, especially because, it is a school and it's actually both of our alma maters, Fordham University. For, the students in the audience, I always like to kind of rewind and let's kind of begin kind of at square one. Let's talk about the path that, laid the proverbial road to your current role. And you studied economics in Colgate University, so you were very clearly focused on, investing and these kind of larger themes that you touch upon. And then you began your corporate governance focused career at Lord Abbett in 2004, and you simultaneously completed your MBA, which is incredibly impressive. You're very busy, but what are the key takeaways from those earliest moments in your education and your career, and how did corporate governance really even hit your radar and investment stewardship as well?
Yeah, well, it seems so long ago, but it all sort of fell into place by accident. So when I graduated Colgate, I moved to Washington, D.C., and I took a job on the Hill. And I worked there for about a year and a half. And I was a political science minor. And so I thought that political science, economics, maybe policy driven, that would be a passion of mine. I come from a political family, and I thought that would be a great fit for me. It clearly was not my destiny. I didn't last very long there. Much respect for people who do that. It was just not for me. And so I did the terrifying move, according to my parents, of leaving my job and driving up to New York in a U-Haul with no job, but with eager Colgate classmates waiting for me in a studio apartment in New York City, right, to create the dream. So I had to make it work. So actually, I applied for a temp job. This is very random, but I got a temporary position as the assistant to the COO at Lord Abbett. And at that time, while I had interest in financial background in investing and in Wall Street in general, I really didn't have any foot in the door. I had never had an internship. I worked at home most summers, on factory floors and waiting tables, and I didn't really have the traditional, experience in the internship space. And so when I got the internship, the temporary job, it was in Jersey City and living on the Upper East Side of Manhattan. I thought it was in a different country. And so I was very nervous about how long it was going to take me to get there. I needed to take a train and a path. I didn't know what the path train was. I was super confused. I think I got there 4 hours early on my first day. But that's a long story short. So I sort of stumbled upon it, to be honest. And then it had turned out that the assistant that I was temping for, that turned into a full-time gig. And so I was the assistant for the COO for a couple of months, and they recognized that I had, some hunger and eagerness in creating a name for myself and a pathway. And it just so happened to coincide with the SEC's ruling that mutual fund companies had to disclose their proxy voting records. So it was right at that time. So I was working at a mutual fund company. They were not disclosing their proxy voting records. I didn't even know what a proxy vote was or a policy or anything about it. I still have my first notebook with all of the terms that I had questions on, reading, about the space, and I was just very overwhelmed. So that's really, so I stumbled upon it. So the COO, looked to me to say, hey, I think she can do this. We need somebody to manage this process, work with our investment teams to make sure that we're voting on on behalf of the best interest of our clients, put policies together, meet with our board of directors of the mutual fund, talk about our voting, talk to the portfolio companies on our voting records, and sort of the rest is history. So I did just totally stumble upon it. So I know a lot of, students on the call might be anxious about, forging your way and making sure you have a very clear path. I was very fortunate to end up doing something that I really loved that I had no idea about on my first day of work.
This is why I love this question, because this is the great answer that you get. And, we're going to get into, the point you made about, mutual funds kind of newly having to disclose their proxy voting records. You and I will agree today, wow, that seems like, yes, it does feel like a long time ago, and we're going to get into that. And it also occurs to me that your kind of diplomatic moment in the Hill probably serves you well in your engagements and pushing these issues forward. So again, I love this kind of question, because, this is kind of, again, it's the path that lays, the road of the career. So it's fascinating to me. So, you started, again, really more focused on governance, and we're in this world now of these broader themes of investment stewardship, and it's not just G, it's ESG and sustainability. But because you started in this kind of governance side, I want to dig in on that a little bit. And, again, with the definitions and maybe, kind of setting a level for everyone. What does corporate governance mean to you?
Yeah, sure. So corporate governance really refers to the structure within which a company is managed, right? Simple as that. So in other words, it's the practices and the policies and processes around which a company is controlled and operated. So we believe that sound corporate governance really creates a framework that allows a company to be managed in the best interest of shareholders and broader stakeholders. And, what do I mean by that? I can give you some examples to highlight that. Annual election. So my job does bridge a little bit of my previous life in politics, because a lot of this is the same. But as shareholders, as we mentioned, you have the right to vote on the election of the directors that oversee the companies that you're invested in. We support annual voting on director elections. It might be of surprise to some, but some companies in the U.S. and elsewhere have what we called a staggered or classified board, whereby the directors serve multiple year terms, and we as shareholders are only allowed to vote on a few directors at once. So it's not the whole slate of directors that are up for election at the annual meeting. So we really see that annual elections is in the best interest of shareholders because we want to give a voice and promote accountability and express our views to each of the directors on an annual basis. So we engage with companies that do have a classified board and encourage them to declassify them, and really promote an annual election cycle. Single class share structure is another corporate governance area that we focus on. So some companies, listed companies, have dual class stock. And what that means is that shareholders of one class, and it's usually the founder and his or her family and friends and significant others, they have substantially more voting power than the shares that are offered to the general public or shareholders such as GSAM and our clients. So this is clearly, we're at a disadvantage to common shareholders, and that, in our view, decreases management accountability. So your vote isn't as loud, one share, one vote, your vote is diluted. So we want to be sure that a single class structure promotes better corporate governance accountability. And then on executive compensation, that's another corporate governance area that we spend a lot of time on. We'll talk a little bit about how that developed, but we have the right to vote on the named executive officers' compensation plans, either on a 3-year or an annual basis. And so as shareholders, it is important for us to pay attention to the pay that it is awarded to our top executives. So it gives us an opportunity to encourage alignment of shareholder interest in top executives. So what we do is we look at the plan, see how it's structured. Are the financial metrics that are tied to the short-term plan or the long-term plan, do those make sense? Are they rigorous enough to promote accountability? Are they rigorous enough to retain talent? We want to be sure that we have the best people running our companies, so we engage and vote in that way. But the ESG space obviously has gotten a lot of attention, but and E and S certainly nowadays, but our foundation is around the governance. I think that's underlying all of it. So ultimately we look to the board of the directors of the companies that we're invested in to set oversee the company's strategy, risk mitigation, and then oversee strategy on key environmental and social initiatives as well. So in many ways, it just all comes back to the G of the ESG.
I couldn't agree more with that assessment, because without the G, how are you implementing the E and the S, and how are you thinking about the sustainability of the business and how, the company serves its broad stakeholder base? And I think it's important for the audience, if this is new to you, to kind of understand that, within the broad kind of role of investment stewardship, G is just one part of it, but it is a very important part. And it, in my experience, it's kind of there, the best policies and practice, you want them in place to prevent kind of that proverbial country club board, the board that might be kind of serving itself, but, how are other stakeholders of the company doing? And the work that Catherine does through engaging and voting policies is so incredibly important in driving those best policies and practices. We're digging in a bit on the governance, but I think that's important. And you touched upon this with, even the unexpected surprise to me that, the notion of mutual fund disclosing its proxy voting records. But, I'd like to understand, really, if you could talk about, the early days, kind of, when we kind of both started in this space, and what governance looks like then, and how has it shifted, and were there any kind of key moments or key stories or themes that kind of drove how you think about changes and the evolution of best policies and practices?
Sure. ESG was not used as it is used now. You hear it on the news. It's on every article. There's many publications, and people focus about it. It wasn't it was around, but it was certainly not as prominent as it is now. So it was very much the G and a very little E and an S. So at the time when I, started in this space, first and foremost, in looking back, is engagement itself was pretty new. I know that there were certain, asset owners in the space that were engaging heavily on certain, values issues. But engagement from an investment stewardship perspective was relatively new. you had the investment teams, whether active or not active, engaging with companies on a fundamental basis to conduct their due diligence and research on whether they wanted to buy or sell a stock. But that wasn't the same as really digging into, corporate governance specific issues, unless there was a red flag at a company, and maybe the investment teams would do that. So engagement in itself, became more of a concept and was developing during that time. It was, who are you going to engage with, right? So it was traditionally, investor relations were, the main point of contact for companies, but it developed more and more, meeting with members of different management teams, meeting with the CEO or even board directors themselves, to get a sense of, how the strategy of the company is running, who oversees it, who makes the decisions, who's in the room when these conversations are taking place. So the engagement on, from a buy-sell decision, it grew much broader at that time. And then we saw those roles shift as well. So it was traditionally IR, like I said, but then more, speakers in the room and people to talk to. Another observation from, back then is we don't have the volume of shareholder proposal. We didn't have the volume of shareholder proposals back then that we do now. And I will, the shareholder proposals get a lot of attention, but they still are a very small number of the proposals that we vote on. So just for context, we vote on about 110,000 voting proposals every year, which is like a crazy number, but that's what it is. It's only 0.2% of those proposals are put forth by shareholders. They get a lot of attention. I'm sure people read it in the news about, asking companies to submit climate plans, asking companies to put more women on their boards, asking companies to disclose more information about their diversity practices. We spend a lot of time. Those proposals are very nuanced. It's very important for us to, vote thoughtfully and respectfully of both of our clients' wishes, but also for the companies themselves. We want to engage with them and really understand what it is we're asking them to do. That the volume was just not there then. So we didn't spend a lot of time engaging or voting on those types of shareholder proposals. And then the third thing that is newer is around the executive compensation votes. So say on pay is what we call that. So you have a say on the pay. That came about as a result of the financial crisis, where the executives in major companies were seen to be getting large paychecks, and that you needed shareholders to have a say on that pay. And so that came around, after the financial crisis, and now is a regular part of conversation when we're talking to companies or when we're casting votes. So that's how it's sort of evolved over time. There's many other, things to consider too, the E and the S, what the conversations that we're having now, we weren't having back then. I think that has a lot to do with like client interest and as well. So that's my observation from way back then. It took a while to like dig back that far.
No, it's fascinating. And you bring up so many interesting points that I want to dig into. And I even think kind of the point around, the small percentage of shareholder proposals that are versus the regular proposals that you're voting, things like approving the auditor. What I assume though is that even though, from a time basis, it's probably more than that percentage represents, because it's a shareholder coming up with like a very discrete action that they want the board to either take or consider taking. And so there's probably a lot, I would expect, more thought that may have to go into those than maybe some of the more clear cut, items around auditor, for instance, like I said.
Yeah. So we develop our proxy voting policies, and so they're public on our website. It gives companies and our clients transparency into what our expectations are when we cast votes or when we look at company ballots. And the reason why we do that is to either give engage proactively, right? So a company is very clear of like, how many women are we expecting to be on a company board? What do we think about? What are our poor pay practices and things that we look out for? What do we think about tenure or overboarding? So all of those sort of policies, which are pretty standard, right? We think good corporate governance is good corporate governance. There's that very few exceptions, except based on where the company is located, right? We have market nuances, but those policies are pretty standardized. It's the shareholder proposals that aren't always included in the policy because they're either new or they're different or they don't quite fit what we've seen before. So you're right, Dan, that we spend a lot of time there because we may not have a point of view at that time. It might be a new proposal.
Yeah, and I'm glad you pointed it out because I think it's such an exciting development, and I think there's other areas we're going to get into, proxy access and things, universal proxy voting, and it's really kind of becoming more of a democratic process, aligning itself a little bit more with that kind of election and what that looks like. So I think it's really interesting. Something else you said that I really thought was fascinating, and it ties into something I know we bounced around in preparing for this, was that you have engagement on ESG, and then there's also investment teams that are engaging around what's this balance sheet item, or what happened to cash flow during this quarter, or things of that nature. And part of the reason I found your career to be so fascinating, being in governance back in 2004, was again, that's kind of when, as an activist, it really started to hit my radar that governance wasn't just an afterthought. It was as important of kind of a consideration as operational improvements that a company could take to improve value. And so I'd love to know kind of, within your prior firms or even your current role, what does that dynamic look like between, you, a governance and investment stewardship expert, having this kind of top-down approach on thousands of companies and seeing what works and what doesn't, and kind of the data behind that. And then maybe some of the investment teams that have maybe more of a bottom-up relationship with a company. Do you engage at all, or do you ever flag kind of companies for consideration? Is there a wall between that?
No, so how the team is structured is my team sits within the investing business at Goldman Sachs Asset Management. So I report directly to our CIO of our public equities business. And so we're very much ingrained in the investment process. This is an investment decision. At the end of the day, we are fiduciaries to our clients. So that's where we live. I know other firms have it structured in different ways, but this works for us. So I sit within the investment teams. The portfolio managers are all around me. I work on a big open floor, and happy to be back in the office. So it's very much collaborative. So while we do what we call top-down engagement, it's because we set policies and frameworks around what good governance practices look like, and then engage on them, or engage with the portfolio managers together on, what does good look like? Here's some examples. Here's what you should do to improve. Here's some feedback on ways of things that you might want to change. And then the fundamental investment teams can also engage too, and that's where it gets more company specific. So we again set best practices, and then they can get into the details because they know the companies more than I do. I have 10,000 companies I need to vote, and they're more concentrated either by sector or by product. So it's very much a collaborative nature. It has to be that way in my view, because we need to have a consistent voice. And so when we're engaging with a company, my team can't go off and engage with a company about what board diversity looks like, and then the portfolio manager speak to them the next day and have a different point of view. The messaging would get lost. It's not consistent. We really need to have one voice. And so that's where my team can help set strategy and say, this is our policy around board diversity. We expect all boards around the world to have at least 10% women on them. That's the message, and and engage with you as you will. So that's really important that we do that together. It's not meant to be combative, right? So we are shareholders of companies that we want to create long-term value in. We are try to partner with the companies when we're engaging. We ultimately, our goal is to identify and improve upon key ESG issues. So there's a mix of ways that we can do that. The first way is we get a lot of inbound requests from companies who want to engage with us, and that was traditionally how it worked. Back in my Lord Abbott days, back into MSIM and now at GSAM, companies do solicit shareholder feedback, right? They are interested in to know what it is that we are looking for and our expectations of them. So we'll often get reached out to directly to say, listen, we're crafting a proxy statement. We want to include this type of disclosure around our retention policies and around our diversity hiring practices. What do you think about this? or we're in the middle of a board search and these are the types of skills sets that we're looking for. Do you think that that's what we should be adding to the board? So we do get a lot of, it's constructive feedback. It's what we call shareholder relations. Like those types of conversations are super important. They don't always get as much attention in the like the media or the NGO space, but I think, from a shareholder value proposition, that it's super important for us to do that. And then we spend a lot of our time on the outbounds, and that's what we call really our thematic campaigns around different engagement themes. So we identify, we have a focus list that we set every year. It's broken down into 3 different pillars. The first is around, as you mentioned in the beginning, around climate transition. So we spend a lot of time identifying companies that we need to engage on specific climate issues, and we can talk a little bit about some of those specifics. Then we have the second pillar is around driving inclusive growth. We have a very strong diversity policy and what we expect our boards to look like. I mentioned all companies around the world, we expect them to have at least 10% women, unless that market has a higher standard. So for instance, in France, they have a 40% expectation that women should of women on boards. And so we want companies in that market to meet that. And then the third is just around corporate governance. And we talked a lot about that. So we are, we reach out to companies to say, we've done some research. You are on a framework. You have some items that we want to engage you on. We want to see some improvements over time. So we'll reach out directly to them.
That is a really helpful overview. And again, you've given us so many great things to think about. So I want to circle back to something you said that just sets up a point I really wanted to discuss with you. It's the structure that you talk about, that you sit, in that investment side as a fiduciary within kind of the CIO, oversight. And I really agree with that. I know there are merits, other firms do it other ways. And I certainly understand kind of some of the rationale for it, but I prefer the approach that you have. And again, that notion really sets up what I want to do. And I love doing this is I characterize it as dispelling a myth. And it's kind of a myth that I'm surprised to this day still persists. But that ESG and sustainability improvements or a focus are kind of feel-good concepts that don't translate into decreased risk or increased profitability and increased shareholder returns. So I'd like to get your thoughts on that.
Yeah, this comes up a lot. So for us, ESG and sustainability are used in different ways at different shops. You hear them used interchangeably, but I'll just focus on how we think about them. So for us, like ESG is not a feel-good issue. We believe that sound ESG practices can drive value creation and improve long-term performance. So it's not about values, it's about creating value. So it's important to highlight that we take a materiality basis approach when assessing ESG issues. So not all ESG issues are relevant for every company, right? There are a lot that overlap, but it's not material for everyone. So for an example, when we say we're engaging on ESG, that's going to look very different across the companies that we're engaging on. So for example, we might be talking to a large US tech company and on such things as cybersecurity, employee retention, diversity, inclusion. Those are all very material issues to that business. Then we might talk to an energy company, and then we're spending all of our time talking about greenhouse gases and managing the climate transition, right? Not cybersecurity and maybe not retention. And then we'll talk to a large retailer, and then we'll think about how, talk to them about how they're thinking about human rights and its supply chain, right? So those are all ESG issues, but they are very different. And so we spend a lot of time making sure that we're having quality and quality conversations with companies and not wasting anybody's time. So there are various frameworks that we can use. Like, how does one define if an ESG issue is material? There are various frameworks out there that help guide investors and companies in the ESG issues. And so we're big advocates, and you mentioned at the beginning, of SASB, which stands for the Sustainability Accounting Standards Boards. They create a standard and a framework which outlines material topics for each industry. So so say if you're a tech firm, they'll say, well, cyber is material here. GHG emissions is less material for you. So they provide a list of all of those material metrics and topics that companies can use to help create their disclosures and look they don't have to disclose everything that anybody has ever asked them to. You look at SASB, it's narrowed down, it's quite thoughtful. And then we encourage those companies to report against those metrics. We know that it's not always perfect, right? There are different points of view on how strong materiality lens might be applied, but that's where the dialogue comes in, right? So we get a lot of feedback from companies about, well, we disagree with SASB saying that this data point is important to our business, and let me tell you why. And so then we have a dialogue and we understand. But what that shows to me is that a company has thought about it. They've taken action on it. They've made a conscious decision, like either to report or not report on it. And that to me is equally important. So one of our engagement campaigns, which I had mentioned before, is engaging on companies to encourage them to use the SASB standards. So we screen a list of companies. We've identified these companies don't have any reporting according to SASB. Let's go talk to them about, first of all, have they heard of SASB? There was a time, it's not as, it doesn't happen as often now, but there was a time that nobody knew what that acronym meant. And believe me, there's so many acronyms in this space. So I can understand that, but I spend less time, explaining what SASB is now and sort of getting into the nuances.
Yeah, I'm glad you brought up SASB, and again, kind of in this, theme of this is really very much financially material, these topics. I mean, I think the SASB frameworks for, the various industries are great in that, again, they are there to identify these kind of sustainability material factors around sustainability. But like from an investor perspective, when you look up and down that list, it actually helps you really understand the drivers of businesses within specific industries. And so they're really not separable. So I'm glad you brought that point up. I think we're going to get to questions in a bit, but I definitely want to walk through, highlight some engagements, the examples that you can share with us. And I know, you guys are doing great work, very important work on diversity, and also around climate transition and just a number of themes. So, any way you want to weave those in as well, I'd love to kind of hear about some of those engagements.
Yeah, sure. So let's start with climate and the E of the ESG. So we view climate to be a material investment consideration. We see what's happening around the world in terms of the environment, weather patterns, and the like. So as a result, when you say engaging on climate, that is like drinking out of a fire hose also. There's like, which way do you go with that? That's so many different angles. And so we have really 3 objectives when we are engaging with companies on climate. The first is around disclosure, and the second is targets, and then the third is implementation. And I'll touch briefly on each of those. So on the disclosure front, we have a campaign where we identified and engaged with 271 companies that were not disclosing emissions data that were material to their business. So that is that SASB said scope 1 or scope 2 or scope 1 and 2 or scope 1 and 2 and 3, depending on the company, because again, everything is material based on that business. Those companies were not disclosing those scopes. And so we engaged with them, encouraged them to do that, walked through the process of why this is important. 23% of those companies that we engaged with have increased their disclosure since engaging with them. And so looking at and how this weaves together with our proxy voting, because that's super important too. But we launched that campaign in October of 2020. So we have quite a bit of time under our belt now. And there's, I know we're not the only ones engaging on this, but for those companies that have not shown any improvements in their disclosures, we do reserve the right to, escalate our voting activities and may vote against directors to express our points of view. So if you're not taking the calls, you're not getting the hint, we might do a vote against. The second is around targets. So we're actively engaging with companies in material industries. I use the word material a lot. So and so think like energy, mining, the utility space, like material industries that do not have any targets on reducing their GHG emissions over time. So not only do we want companies to disclose, and we're working with those companies to do that, once they do start to disclose, how are you now thinking about how you reduce those over time? And so we talk to those companies. So of the companies that we would expect to have some targets and reduction, and those that are silent on that, we will go engage with them. We have about 120 names on our list right now that we're doing that. And then ultimately is and then the last one is on implementation. So we're looking ways to engage a smaller set of companies, in real high impact companies, on the quality of those emissions targets and how they fit into a broader net zero strategy. So it's disclosure, it's how you're going to reduce, and then your plans to reduce. Is that a quality plan? And quality is really hard to define, and so we need to do this on a company by company specific basis. So that's what we're doing on the climate space.
It's a lot, and it's a big change. In terms of, I think the movement towards disclosure is beginning to take hold, but then the work comes after that. The actual reduction and meeting those targets and goals. I know Goldman, like as I highlighted, you guys also have, taken some pretty bold and I'd say kind of, first in class steps on the diversity front, especially around, for instance, boardroom diversity of companies that Goldman takes public. But any examples on the engagement side or any particular themes around diversity that you're focused on right now?
Yeah, and this one I'm really proud of, to be promoting the work here, and we have the whole support of the firm. Like you said, we won't take any companies public without at least 2 diverse board members. Our private equities business has similar expectations of their board composition. We believe, and I think this is really important, because when we talk about diversity, it's often like, oh, it's the right thing to do. It is the right thing to do. Let's be very clear, but it's a business imperative, and it's one of the tools that we have as shareholders for push for positive change. And we really do believe that diversity is embedded in long-term performance, right? You have diverse teams, you have inclusive teams, you will perform better in the long run. So yes, it's the right thing to do, but it also will help drive better returns. So we've been using our proxy voting policy for several years to push companies to increase their board diversity. So we started it publicly. There's been a lot of conversations not within the proxy policy, but we started in 2019, where we said we vote against the chairman of the nominating committee. So boards have different committees. The nominating committee is tasked with finding board members, among other things. But if you were an all-male board in 2019, we voted against the chairman of that nominating committee, and we voted against around 250 companies in the U.S. And since that vote, 68% of those companies have now added at least one woman. So we're seeing a great progress. Again, we know we're not the only ones doing this, but we're really proud to be part of the conversation. Then the following year in 2020, we made that policy global. So it started in the US, but in 2020, we voted against almost 900 companies around the globe that did not have any women. So it was just a one. Our expectation was one. We voted against the entire nominating committee. So we, evolved our expectation in the US, but we thought we would make a bolder stance globally. And 27% of those companies since 2020 have now added at least one woman. So we are seeing progress there. Now we look to 2022. So we're evolving our process. And like I mentioned, now our expectation is that all companies around the globe have to have at least 10% women, or meet the higher local market guidance. And we did that for a few reasons. We were seeing, unfortunately, some tokenism, the one and done approach, particularly on larger board sizes, and particularly outside the US. So we wanted to address that. If you are a larger board and you have one woman, if you are 12 member board, you should have more than one woman on that board. And so that's why we moved it to 10%. And we're also acknowledging that there are better quotas out there, and so we wanted to adhere to those. But diversity is not just about gender. It's also about race, ethnicity, sexual orientation. We started in the US to incorporate other forms of diversity in our voting policies. So in 2021, any company in the US that did not have at least one woman and one other diverse board member, we voted against as well. And so evolving on that, there's a lot of evolution in this space, right? You have to take little steps at a time. For 2022, which that the season starts in March, so just a quick few weeks away, we are explicitly expecting companies in the S&P 500 and in the FTSE 100 to have at least one ethnically diverse director, as well as meeting our gender expectations. So we're going to be very clear about that now. So quite an evolution, something that we're really proud of. We have the strength and, again, the support of all of our investment teams. We are a global firm. We have people on the ground in many markets. We vote in 71 markets. My team is regularly engaging on this. We have often have some uncomfortable conversations. Hopefully it won't be uncomfortable much longer as people get more on board. But, we're really passionate and focused on, the importance of performance.
We are getting close to anyone who has a question, please send it in now. A couple last questions for Catherine before we take questions from everyone who's listening in today. What was the impact of COVID on engagement work? How did it change it? Did it, what were the outcomes of what we've all just gone through?
Yeah, it's sort of still going through. So our engagements on COVID, it really demonstrated to us that sustainability is not just about the environment, right? It's about the focus on the S in the ESG, where the S had some bit of a backseat to climate concerns, or the E, but we really knew that COVID brought out a lot of S issues. And so as long-term investors and shareholders, we wanted to focus these conversations on the long-term or permanent strategic changes and operational changes that companies were having in light of COVID. So not just the near term, because we're all hoping we were getting out of this quickly, but like what changed we would call it that outlasted COVID. And so we saw two sort of trends. And this is, for everybody on this Zoom call, companies are, really grappling with the implications of a flexible or an entirely work from home environment. So in a remote work world, it's really critical for management to emphasize measuring, monitoring, and improving upon employee engagement, right? You still need to engage your employees. It's super important to do that. You need to keep them energized and engaged. And how do you do that? So many companies that we talk to, increase the attention around, which sounds really silly, but it's important, employee engagement surveys. So we saw, we talked to companies who, some who had done them for the first time, some were just getting more creative. Then what we also found is, these remote work opportunities really allowed for new workforce recruitment opportunities. So, for example, we talked to a company who noted that the flexibility of remote work just allowed them to recruit talent in new regions that they weren't able to tap into. So, I live in New York City. I think it's the best place in the world. Not everybody wants to live here. And so if you have remote working, you can, tap talent from other parts of the country or the world and, and add to your diversity of thought and workforce diversity as well. And so that can positively impact their ability to recruit talent. The other observation is that we just saw an increase on focus on employee benefits. That was a great thing to see that came out of it, a silver lining. I know there's a ton that's not good about this, but we've had a lot of conversations around focus on childcare, mental health resources, companies dedicating a lot more attention to these programs and, engaging with employees on it, which circles back to my previous comment. But, the focus around, taking care of your employees really came to light during COVID. And I hope everybody feels that. But it came through very strongly in our engagements.
Yeah, I think that's such an important point, and it's really a big part of the work that I do within IDES is in my experience across really every company I've invested in, when the employees are doing well, customers are doing well, and shareholders do just fine. And so putting that front and center, I think it's good for employees and communities, and it's good for investors too. And so it's kind of that kind of optimal win-win. So now I'm going to turn to some questions that we've received from the listeners. Starting off with, if you had to identify one key challenge to engaging with portfolio companies on the topic of net zero, or we could even broaden it to kind of climate transition, what would that challenge be?
That's a great question. I talk with my team about all the time. the challenge that we're struggling with right now is around the definition of quality. So we've set ourselves on a few key areas, making sure there's certain governance provisions that we're looking out for, making sure that there's reporting and frameworks that we are aligned with, one of which is the Task Force on Climate Related Financial Disclosures, which is the TCFD. So we look for that. We look for targets that have interim goals, right? Because 2050 is a long time away, probably will happen quickly, but we want to be sure that the management teams are put into place to be held accountable now, not just set these lofty goals and then go retire and nothing happens, but what is the accountability around it, and then how do you measure and monitor that at that time. The challenge around that is you can create this amazing framework. A lot of companies are doing like a lot of the things, but like you have to dig into the nuances and really understand the differences between the businesses and like what growth path that company is on. Are they investing in R&D? What technology do they have available to them? So like each company is different. And so when me and my team come out, we talked about the top down. This is much more of a bottom up process than a top down for us. So that's challenging because we may not have the right level of expertise that's needed for those company calls. So that's where we really need to lean into the engagement with our investment teams as well.
Yeah, that was a great question. Another question I'm seeing some crossover is kind of around, I'm going to consolidate several questions, but it goes to your engagements and focus on disclosure. And many of them are focused towards environment, although I think I could argue it certainly plays to diversity and, employee, for instance, safety incidents, is data integrity on these topics. How are you engaging with companies? And clearly we don't have one kind of standardized reporting requirement around these topics. So that's kind of another aspect of disclosure, but how are you handling that? There's so much more data, but you've got integrity and then kind of standardized versus non-standardized reporting formats.
Yeah, I mean, that's why we really, huddle around the frameworks that are out there and that are generally accepted in the investment community. So SASB, like I said, TCFD, like I said, we need some standardization and able to know what we're looking at, but then also to make peer comparisons. And we can't do like apples to oranges all the time, and we'll get the analysis wrong. So we talk to companies about how they assure their own data is valid too, right? There's a lot of auditing going on by third parties coming in and doing assurances that the data is correct. One of the reasons that we embarked on the climate disclosure objective is because we do have a lot of clients who are interested in creating portfolios around their climate goals and objectives. So for instance, we might have clients who want a portfolio that is a lower carbon footprint relative to the benchmark, or we might have a client that wants a portfolio that will reduce, will see reduction in emissions over time. And so in order for our investment teams to make portfolio decisions on who to buy, they need that data from the companies in order to, assess, is this a good fit for this client's portfolio or not? What we're seeing is that for those companies that are not disclosing that themselves, there are a lot of third-party data agencies out there that are either estimating that data and then sending that out, and you can collect that. And what we have found is that it's often wrong. So we don't want to, put our clients' capital at risk by using a wrong number by a third party in their portfolio construction. So that's why we embarked upon the engagement on disclosure to encourage companies to disclose that directly, and not just to us, but to the public. So make sure it's on their website, make sure it's transparent, and give us access, because the data quality is really in question. So we want to be sure, we can do the best we can and help, communicate that.
That's great. Well, we've got the professor. So is there anything that stands out to you?
Well, many good questions here. So I'm not sure that we'll be able to ask each and every question. So let me put together two questions from two different persons. What progress are you seeing in practice, especially with reference to race diversity at board levels? And any examples of engagement on diversity, equity, and inclusion issues that focus on benefits at mid-level representation, issues that move beyond counting diversity on the board?
Mm-hmm. That's a great question. So I should have said that our board diversity, it just doesn't stop at the board. Like the diversity question is not, it's not like, oh, we vote here and we're out of there and we don't talk to them about anything else. It's a starting point or an entry into a conversation about broader workforce diversity. So progress that we're seeing is around disclosure of workforce demographics. There is a form in the US for public companies that are over 100 employees, I believe, need to file with the federal government a form EEO1. It's the Equal Opportunity Employment one survey. One is the number one. And that what that is a breakdown of the company's workforce by gender and also by race and ethnicity, and by the different levels in the organization. So and it's not required to be public, it just has to be submitted to the government. And so what we're trying to do is encourage companies to disclose that survey. We do recognize that it's not perfect because job titles and even, at my firm versus my competitor's firm, our titles are different. So it doesn't always align to what the goals and objectives are in that company, but it is a helpful tool for investors to be able to do some peer analysis. So everybody has the same form and you can see what the disclosures look like. So we're asking companies to make that public. And we've seen when we started doing that about 2 years ago, there was a lot of resistance in doing that. We're in a litigious society. I'm not going to speak to the reasons why the companies wouldn't want to do that, but we did get a lot of pushback. We're seeing way a very extreme increase in the number of disclosures that are being made public now around that. So we are able to then, look at the board level, look at, the executive level of using that information. And that's a helpful way for us to measure and monitor progress over time too, because you can have that year over year.
Two more questions, one from the audience and one that I like to wrap up on. What is the future of investment stewardship? And we know kind of universal proxies and there's things coming out, but where do you see this headed?
Yeah, so we started from, the sort of shareholder relation feedback, engagement, not knowing who to engage, sort of what to engage on, sort of, I always equated it to like throwing spaghetti against the wall, like what themes came out of this year's work, it was what stuck. The future I see is that, and what will come out of our team is that we have to be much more targeted in our engagements. Our clients are really focused on outcomes. Like it's basically like, what do you do all day? What is the result of your engagement work? And so you want to make positive outcomes, and how do you report on those outcomes? Now, again, I've said it a few times, we are not the only shareholders engaging on these very similar topics. And I think that that's important to do because we don't want to go out there and ask companies to do something that's outlandish and just crazy. That's not a use of anybody's time. We want to sort of move it out as a market. So we are very much collaborative in our peer space. And Diane, that's how I know you. We spend a lot of time at the CII and talk and share thoughts and observations. And so we can help move the market together. And so I see that going is, much more specific, targeted, more reportable, outcomes, and to showcase the work that, stewardship has on making positive impact.
Yeah, I think that makes so much sense. My last question, and it does tie in, is really what advice do you have for students or people that are considering maybe a minor or a major career change because they like this idea of investment stewardship and it's interesting to them? And I'm seeing kind of questions. Do you recommend kind of, for instance, specific certificates around ESG or programs or any other advice that you have for our audience today?
Yeah, it's a great question. So I don't have any of the certificates, but I know a lot of programs are coming out there with them, and I, encourage everybody to look into those. I know it's exciting that space has evolved. Like it wasn't offered to me when I was, back in the day. So I think that's super exciting. I know there's a lot of, schools that are, doing courses around this. I remember taking a corporate governance class at Fordham while I was in corporate governance at Lord Abbett. So it was like really fun to be the student and the worker at the same time. So there are ways to sort of get into it. I think it's just a really exciting space because you can see for yourself some positive change, and you're helping your investors use their capital to push for that change, right? So out of COP26, the larger debate about whether investors should divest from fossil fuels or keep active ownership, we're very much in the camp of, being active. And I think it's a critical tool for us to keep companies accountable. Like if we're owners of the company, we have a seat at the table and we have access to management and we can have a conversation. If you don't own the shares, it's pretty likely that they're not going to call you back. So I think it's important to be, stay active and engaged. I read the Wall Street Journal, like most people. I'm not surprised, but there's so much more content around this space than there used to be. And I just find that so fascinating. Like I send my parents all the time, like, look at this article. Like this is what I was talking to you about. And they like know a lot more about what I do, which is great. But I think there's just a lot of ways to, to stay active in it, explore those certificates. I think that that's a great way, stay engaged with what's happening in the news. I see the amount of time I hear ESG on like CNBC, it's crazy. So there's a lot, it's just an exciting space to be in.
Do we have time for one last question? Diane?
Sure.
I see here a question from my colleague, Laura Rittenhouse. And she's curious to know if Goldman monitors a company's political action activities, and if so, in all geographies or selected geographies?
So I can't speak for Goldman Sachs, because I work in the asset management business, okay. But it's a great question. And it's something in the stewardship space we spend a lot of time looking at, because there are shareholder proposals around, political spending activities. And so we have to look at, company disclosures when we're making an analysis on those votes.
Dan, go ahead if you want to ask the last question. I'm just looking at the clock.
Well, I just want to, thank you, Catherine. I can't tell you how much I have been looking forward to this, and really just a tremendous experience to be the beneficiary of your incredible wealth of knowledge and the insights that you can offer on so many topics, and are really leading the charge and, again, the evolution of investment stewardship.
I want
to echo.
I'm sorry, go ahead.
No. I was just going to echo what Diane just said, and I want to thank both of you, Diane and Catherine, for a very enlightening and engaging webinar.
And I thank both of you as well for the invitation. It's really, I can talk about this space all day long. So I'm glad we kept it in an hour, or else I've been here all night. But thank you so much for the opportunity. And, happy to, follow up with any feedback, questions if anybody has any. And again, just very grateful for the opportunity.
No, thank you. And I want to just say to our audience, if you enjoyed this event, please check your email for information on future events and share the invitation with others. And thank you again for joining us.